A striking divide is emerging in the global commodities market. Veteran strategist Jeffrey Curry is maintaining a cautious, short-term stance on gold while also projecting the potential for prices to approach the $10,000 level over the longer cycle. Curry, known for previously identifying major commodity upswings and energy market turning points, believes the near-term pressure on gold is being underestimated. His view centers on recent geopolitical tensions that pushed global energy costs higher. In response, several central banks in energy-importing economies reportedly shifted liquidity priorities toward stabilizing domestic financial conditions and securing critical imports, reducing momentum in gold accumulation. Based on that framework, he sees room for gold prices to retrace toward the $4,000 range, with deeper downside scenarios potentially extending lower during periods of stronger dollar demand and tighter liquidity conditions. However, his longer-term outlook remains decisively constructive. The core thesis is built around two structural forces: collaborating AI-driven capital expenditure and tightening supply across real-world assets. In 2026, spending tied to AI infrastructure by major U.S. technology firms is projected to exceed $820 billion, driving sustained demand for energy, industrial materials, and supply chain resources. At the same time, upstream investment in mining, refining, or energy development has remained relatively constrained over recent years. That imbalance could create a prolonged supply-demand gap across multiple commodity sectors, increasing the likelihood of higher long-term pricing pressure. Another key factor is that central bank demand for gold has not disappeared. During the first quarter of 2026, global central banks collectively remained net buyers of gold, reinforcing the view that official sector interest in reserve diversification continues to support the market over longer horizons. In essence, the strategy reflects a two-phase outlook: caution during potential short-term corrections, followed by renewed bullish positioning if economic growth slows and monetary policy conditions eventually become more accommodative.